Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us for this segment, we have Joyce, managing director on Nasdaq's market intelligence desk, where he's noticed some trends in relative strength when it comes to techs. Obviously, something that we are interested in here when we think about the Nasdaq 100 and the tech indexes that they call home here. Tell us what you're seeing in relative strength when it comes to tech.
Sure, absolutely. The portfolio managers, investors, they like to see relative strength. So whether the market's going up or down, they want to see what's outperforming, what's underperforming, and you could look at that kind of relative analysis in a technical way. You don't just have to look at individual stocks or rates or whatever the instrument is. You could do that with ratio analysis as well. And a lot of technicians on the street have been very focus on tech versus the S&P 500. And this week, with the weakness, with the relative underperformance of technology, we're now testing those lows made back in 2021. And before that, we did have a period of about 8 or 9 strong months where there's somewhat of a parabolic move going higher, kind of into those highs of the ratio. That was largely made in the first 8 or 10 months of 2020. This ratio setup is very similar to what we see when we look at growth versus value. So right now we're testing a key support level for the technology sector versus the S&P 500. If you're bullish in technology sector, obviously if you want to be constructive on the market, you do want to see this ratio hold this level. If it breaks down below this level, the expectation is that there's going to be further downside follow through. Now, because it's relative strength, it doesn't necessarily mean technology is going to continue to sell off on an absolute basis. It could just mean it's going to underperform, so maybe it won't rise as much as the S&P 500.
Right, and that's a great point that you make. But let's take a look at the Nasdaq 100. We know how much it is allocated towards tech. So what are some fresh technical levels that you're looking at there?
So, we've kind of been in this the last 4 weeks now. We've really been holding around these June lows around 11,000. Last week on Thursday when we were talking, it was at the same exact level. Friday was a down day in the marketplace, so we rallied back on Thursday midday after a weak CPI in the morning time. So we had a 2% move to the downside early Thursday, then a 3% move to the upside. So it was right around that 11,000 level, which was the June lows. We did sell off the following day on Friday, so we did finish lower really for the first time. This year it made lower lows finally. So this week I should say, we're back to where we were just 1 week ago. So we're up about 2-3% this week. We're back to that 11,000 level. So that's the key level. I think that June low, because we did make a lower low last week. We had a closing price of 10,692. Let's call it 10,700. That's the key range right now, 10,700 to 11,000.
And let's take a look at rates here. It seems as if the market is solely fixated on what we're seeing with the Fed, inflation, rates. Anytime there's a headline out there, and we saw it today when there's a Fed speaker out on the circuit, you can see, tick to tick what they're saying and what they think rates are going to look like on an absolute basis at the end of the year. And the market did not digest it that well midday today.
Yeah, so it's amazing what's been going on in the rate market. And people like to talk about, well, things may already be baked into the marketplace, but just in the last 3 months alone, we've seen the 10-year go from a low of 2.5% right around the first or second day of August to now it's over 4.2%, almost at 4.25% today. So 170 bip plus move to the upside in about 10, 11 weeks. The terminal rate that we know where we're expecting the Fed funds rate to peak at next year is now over 5%. So we've just seen these phenomenal moves higher in rates. That's a headwind for the economy. It's a headwind for a lot of things. It's supports the dollar, which we know is having a record year. It's going to increase volatility. You had as you noted, somebody from the Federal Reserve was out today, alluding to the fact that maybe the overnight rate next year will get above 5%.
Right. Well, and if we look at it on a relative basis, it's still not super high. We've just been so used to lower rates. I think, Brian, it's the velocity of the moves and how quickly these have moved is really what has spooked the market, because it's not typical to see rates or FX or these slower moving asset classes move that quickly.
Right, but it's not high relative to maybe say even 3-4 years ago,
right.
But coming off such a low level.
Right, it's so fast.
Yeah, and the rate of change. Yeah,
right.
That's key. That's key. So if you're the type of investor or corporation that has floating fixed costs, your fixed costs or your floating costs, I should say, your costs are now going higher. So you need to, your margins are getting squeezed, so to speak.
And look how many companies access the debt market at virtually nothing, and that it's being called to now.
Yeah, and so those companies that need to access capital, whenever their deadlines come up where they need to either roll it or go back to the capital markets, it's likely going to be at a higher price.
More expensive, right?
So yeah, so the inflation, as we know, it's still a problem. We talked about the last week's core CPI. The services is 80% of the U.S. economy, and so that month-over-month core services CPI number was the highest since the early 1990s. So it seems like the Fed still has a lot of work to do. I know the swaps market, which is really not my realm of what I follow too closely, but I see a lot of the macro experts talking about how swaps next year are pricing a dramatic fall in inflation. In the meantime, until that happens, the policy risk is that, or from an investor's perspective, the risk is that the policymakers, the Federal Reserve, is going to continue to march rates higher. And if we believe what they're saying, that means essentially we think that they're going to go towards 5%.
Let's talk about Bitcoin, because what's so interesting, since June, it's really done nothing. It's one of the more quiet markets.
Yeah, so the last key kind of technical move we've seen was back in June, as you noted. We broke that 29,000 support level that had been in place since early January 21, and the breakdown bottomed probably within a few weeks at that 2017 high around the 19,000 level, and we've basically spent the last 3 or 4 months consolidating right along that 19,000 support. We've gotten below it a little bit intra-week, intra-month, but so it'll be very interesting to see. The volatility has really been compressed in Bitcoin, with the lax activity, when it's certainly not doing what the equity market is doing, or what we're seeing in other asset classes, which is ironic because Bitcoin has typically been one of the most volatile instruments out there. So I think a big move is coming. We'll just have to wait and see when. But that 18.5 to 19,000 level is key. Again, it was those prior highs from 2017. If that breaks to the downside, maybe we see a flush. I don't want to put a target on it, but we could see a flush lower over the near to intermediate term.
All right, Brian. Appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.